Hey traders, this is MsPutOptions, and today we're going to be talking about options, we're going to be talking about call options, and we're going to be talking about put options. But before we talk about any of those definitions, I first want to let you know that I have a new website opening up at www.MsPutOptions.com. Again, it's www.MsPutOptions.com, and basically it is a website, but it's composed of several webinars, and my webinar/website is totally dedicated to showing new traders how to sell put options. And the reason why my webinar/website is dedicated to showing people or showing new traders how to sell put options is because with put options you instantly receive a credit. And this is why I love selling put options. Okay, so with that being said, let's get on with the definitions. First of all, what is an option? Basically, in a nutshell, an option is a contract between a buyer and a seller. That's all an option is. It is a contract between a buyer and a seller. Now, when you're dealing with call options gives the owner the right to buy the stock at a set price on or before expiration. Now, looking at the flip side, when we're talking about a put option, the owner of a put option has the right to sell the stock at a set price on or before expiration. So let's do that one more time. With a call option, the owner has the right to buy the stock at a set price on or before expiration. They have the right to buy. With put options, however, the owner has the right to sell the stock at a set price on or before expiration. Okay, so let's look at some examples of how a call option is different from a put option. We already said with the call option, the owner has the right to buy the stock at a set price on or before expiration. But let's say hypothetically, you placed a call option. You bought when the stock was at $50 per share. And now the stock was trading at $100. You have the right to buy the stock at $50. Because remember, you bought the stock when it was at 50. Now it has gone up to 100. So you have the right to buy the stock at 50 and not the 100. So instantly, if you have one share of this stock in this situation, you would have a $50 profit, because the difference between the 100 that is presently trading at and the 50 which you bought it at is a difference of $50 if you had bought one share. Now, let's look at the flip side. Let's look at the put option. The put option, we already said, it gives the owner the right to sell the stock at a set price at a certain time on or before expiration. So, hypothetically, let's just say you sold a put, a $50 put, and the stock is now trading for $30. You have the right to sell the stock for $50 and not $30. So, with call options, you are hoping that the stock increases in value. Remember that. With a call option, you're hoping that the stock increases with value. But with put options, you're hoping that the stock decreases in value. And when you start taking my webinars, you'll understand the reason, but I'm just going over some of the terminology. So, let's look at another example. I want to ask you a question. Why do you pay the insurance company a monthly premium to insure your car? Why do you pay it? Now, I know a lot of you are going to say, oh, it's the law, or if something happens to my car, they will fix it. Yeah, a lot of that is true. But let's get down to the nitty-gritty, the real reason why you pay the insurance company a premium, a monthly premium every month to insure your vehicle. Yes, it is the law. And yes, if something happens to your car, they will fix it. That is true. But when we get right down to it, the reason why you pay the insurance company a monthly premium is because that premium gives you the right to sell your car to the insurance company just in case the car crashes and burns. And on the flip side, it gives the insurance company, by collecting that premium, the right to buy the car just in case you crash and burn the car. So once again, the reason why, the real reason why you pay monthly premiums to an insurance company for your vehicle is just in case you crash and burn that car. The insurance company is obligated to buy that car. And this is the reason why you pay the insurance company. Because you want them to buy your car if something drastic like that happens. All right? So, let's look on. So, why does the buyer or the owner of a stock pay you a premium as a put option seller? Why? Why does the buyer or the owner of a stock pay you a premium as a put option seller? Because remember, in the beginning of this whole discussion, I immediately said the reason why I like selling put options is because I collect a premium, a credit, instantly, and this is why I like selling put options. So why does the buyer or the owner of a stock pay you a premium as a put option seller? All right, let's look deeper into this question. So the reason the buyer or the owner of the stock pays you a premium as the seller, as the put option seller, is to ensure that if the stock crashes and burns just like your car did, the seller of the put is obligated to buy the stock. It's just like the car. The owner of that particular stock pays you a premium just in case that stock crashes and burns. And what I mean by crashes and burns, that means that that stock falls to a level where they don't like, or falls to a price that you had agreed upon. Then you, as the seller of the put, is obligated to buy the stock. This is the reason why you collect premiums as a put option seller. Now, that sounds a little risky, but let's look at it a little deeper. So, in other words, being a put option seller is no different than being an insurance company, because you both collect premiums. The insurance company is collecting a premium just in case something happens to your car, they have to buy it. And the owner of the stock is paying the seller of the put, that's who we are, a premium just in case their stock crashes and burns to a particular price. Then you would be obligated to buy the stock. So being a put seller is no different than being an insurance company. And I'm going to tell you a quick story, and then I'm going to leave it at that. I recently, as of last year, got into a car accident. I'm embarrassed to say I got into a car accident with a pole. and I tore up the whole right side of my vehicle. Brand new car. I am 40 plus years old. I have been paying the insurance company premiums for all cars that I have ever owned for years, for 20, 30 years. And they have been collecting those premiums all that time. And when I got in the car accident, the damage cost me and the insurance company $4,000. But if you really think about it, the money that I gave them over the years super exceeds the $4,000 it took to fix my car. It super exceeds that $4,000 amount. So I love selling put options because I am now the insurance company. I collect premiums from people who own stocks, who are hoping that the stock is put to me, meaning that I have to buy the stock from them. And in this hope, they give me a premium. They are giving me a premium, hoping that the stock will crash and burn. And when the stock does not crash and burn, I get to keep all of these premiums, just like the insurance companies. Now, I found this article on Investopedia. And the question was, why should you sell put options? It says 82.6% of all put options expire worthless, meaning the seller of the put is able to keep the premium that was credited to them. That's a beautiful thing. That 82.6% of the time, your option expires worthless and you're able to keep the premium that was credited to you. And could you imagine that 82.6% is factoring in a lot of people who really don't even know how to sell put options correctly? So that number would be a lot higher if it only factored in people who had experience and people who really knew what they were doing. That number also factors in people who just cross their fingers and just throw a trade out there and they say, "Ooh, wow, I got to keep that premium this time." People who blindly trade, not really knowing how to sell a put option. So my belief is that that number would be a lot higher than 82.6%. And if you visit my website at www.MsPutOptions.com, I'm going to show you how you can trade, how you can collect premiums on stocks you don't even own. 95% of the time, you get to keep the premiums. If you don't believe me, visit me, www.MsPutOptions.com.